Let's get our day rolling now with Scott Bauer. He is the CEO of Prosper Trading Academy, here to talk earnings. So this is a big topic for traders.
It is huge, and earnings is really a great time to trade. A lot of people get scared of earnings because of the volatility, because the expected moves are much bigger than normal, and because sometimes good earnings doesn't mean that a stock does well after earnings.
Sometimes it sells on the news.
Absolutely, no question about it. And sometimes earnings could be good or bad, but it all depends on guidance. So that's why we see volatility, implied volatility, option volatility higher going into earnings, because the market is typically expecting larger than average moves.
When you look at earnings as an event, how does that compare to maybe some other trading opportunities in the market? Is it maybe a number one with you, do you think, as a trader?
To me, it's number one, because there's always going to be something to do around earnings, typically around volatility. My expertise in trading that I've done for the last almost 30 years trades around volatility. So what I look to do around earnings, Angie, is take advantage of arbitraging volatility. Everyone knows how you can arbitrage a stock versus the other, but you can actually do that with options, trying to find one option that may be mispriced versus another option. And around earnings, it's a wonderful time to do that.
Explain that a little bit more.
Sure. So we know that option volatility or implied volatility going into earnings, especially the week that captures the earnings event,
tends to go up.
Absolutely.
So those options prices become more expensive.
So those option prices become more expensive. Now, that doesn't mean you ordinarily or have to just sell those options, because they might be expensive for a reason, right? Because the stock is typically going to move in a wider range. However, when you look at one option, let's say on an earnings week, versus an option maybe a week later or even a month later, you can look at the big volatility disparities and the amount of premium that's priced into one option versus the other.
So one might have a lot of premium buildup, might be really expensive, but one might not be as expensive.
Absolutely. Sometimes when I look at an earnings play, one of my favorite types of strategies around earnings is a calendar spread. Sell one option that's expiring close, that has just so much premium built into it, and buying one that's further out.
The next month.
Exactly. And the way that I explain that to people is, okay, I want to buy this option that's out maybe 2 weeks or 4 weeks, and I'm going to finance it by selling an option that is closer dated. And I love looking at calendar types of spreads, whether they're call spreads or put spreads, going into earnings.
Scott, thanks for revealing your trading strategy here.
Absolutely. Thanks, Angie.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.